Hello and welcome back to another video here on the Calm Lucro channel. Today, we're going to break down one of the most common challenges smart money traders face, choosing between fair value gaps and order blocks when setting precise entry points in the market. Understanding how price interacts with these zones is essential because it determines whether you catch high probability setups or end up constantly missing trades by refining your entries too much. In this video, you will learn how price behaves around order blocks and fair value gaps on different time frames, how to identify which zone carries the highest probability in each scenario, and how inefficiency and liquidity voids influence entry precision. So, if this type of content is valuable to you, remember to like the video, subscribe to the channel, and enable notifications so you don't miss the upcoming lessons. And feel free to share in the comments which topics you would like us to explore in future videos. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to continue producing this kind of educational content. So let us begin. As you already know, order blocks and fair value gaps are two zones that smart money traders rely on when setting their entries in the market. Still, many traders struggle to understand which of these areas carries the stronger probability and is more likely to be respected by price. In this example, the market reacts to the higher time frame order block, but ignores the lower time frame one. This reveals an important insight. When price repeatedly fails to reach your entry, it often means the setup has been refined more than necessary. Now, let us break down what is happening in this example. The market was moving in a downtrend until price shifted direction, pushed higher, and after removing the inducement level, finally produced a change of character by breaking and closing above this major high. With that change of character signaling a potential bullish trend, our focus shifts to finding a place to enter long. So where should we look for a long entry on this chart? The first step is identifying the discount zone, which contains both the higher and lower time frame order blocks inside it. If your goal were simply to participate in the move using the higher time frame order block, you could have placed a buy limit at the top of that order block with the bottom of the zone acting as your stop loss. This would have placed you in the trade, and price likely would have moved upward after triggering your entry. However, this type of entry comes with a wide stop loss, which reduces the reward to risk ratio and increases the potential damage if the trade turns against you. If your goal is to work with a tighter stop loss and a stronger reward to risk ratio, then your entry zone needs to be refined. This is why many traders shift their focus to the extreme lower time frame order block at the bottom. At first glance, this seems like the ideal choice because it offers a very small stop loss and naturally delivers a high reward to risk ratio. However, if the extreme lower time frame order block were tapped every time, the market would constantly retrace deeply, creating a zigzag pattern on every swing, which simply does not reflect how price behaves in real conditions. So what is the practical solution? In many cases, order blocks will not be respected. What tends to happen instead, especially on the lower time frames, is that the fair value gap becomes the zone that price reacts to most consistently. With that in mind, we can now combine the concepts and evaluate what price is most likely to respect when approaching order blocks or fair value gaps under different contexts. On higher time frames such as the 1 hour or 4 hour chart, price generally shows a stronger reaction to order blocks rather than fair value gaps. But when we move down to the lower time frames, price is far more likely to respect the fair value gaps instead of extreme order blocks positioned at the outer edges of the move. So let us imagine that price forms a structure like this on the lower time frame. As mentioned earlier, on time frames such as the 15-minute or 5-minute chart, price is much more likely to react to the fair value gap that appears above or below the order blocks and reverse from that gap before reaching the extreme lower time frame order block. Using lower time frame fair value gaps as entry points can be highly effective. Entries based on fair value gaps tend to produce a higher activation rate compared to relying solely on extreme order blocks. In a bullish scenario, This usually means placing your limit order at the highest point of the fair value gap, while positioning your stop loss beneath the extreme order block. The trade-off is that this creates a wider stop loss, and that naturally reduces the reward to risk ratio of the setup. Placing a tighter stop loss just below the lowest point of the fair value gap is also possible. The challenge with this option is that it exposes the trade to greater risk. The extreme order block sitting below the fair value gap may still attract price, pushing the market downward and triggering the stop loss. So even though a tighter stop may look attractive, it is important to weigh the additional risk before applying this adjustment. As mentioned earlier, on higher time frames, our main focus is placing entries at order blocks. Traders can still choose to rely only on order blocks in the lower time frames as well, but doing so often results in missed opportunities because price does not always return to those extreme levels. Now, we have already covered the scenarios in which price respects order blocks, respects fair value gaps, or interacts with both. However, there is another situation you may encounter in the market, one where price respects neither the order blocks nor the fair value gaps. Let us explore this scenario and understand the main reason behind it. You have likely experienced moments when you spotted an excellent setup and a strong opportunity to enter the market after all the rules of your strategy were met. You marked your ideal entry zone, set your pending order on the fair value gap or order block, and waited with confidence for price to return. You felt ready for the perfect trade, yet price simply continued moving in the intended direction without ever triggering your limit order placed at the extreme of the gap or order block. In the end, the trade played out without you. The main reason price behaves this way is the level of inefficiency it creates while attempting to retrace toward the fair value gap or order block positioned at the extreme. When price forms a large inefficiency on its way to those zones, it leaves behind significant liquidity voids. As a result, the market often pauses to fill those voids before continuing. However, once the retracement aligns again with the dominant trend direction, price struggles to move far enough in the opposite direction to reach the pending orders sitting at the extreme order block or fair value gap. This happens because as price returns to its primary direction, it absorbs strong momentum from traders who believe the retracement has ended and the trend is ready to continue. These actions push the market forward in the dominant direction without ever activating the limit orders placed at the extreme levels. If we examine this example on the euro-dollar pair, we can see that the market is in a downtrend and has already confirmed a bearish break of structure by breaking and closing below the most recent major low. There's an order block resting at the extreme, and just beneath it, we can identify a fair value gap. Both areas could be used as potential entry points. As price retraces downward toward these zones, we notice that it reverses before reaching either one. The reason for this shift lies in the inefficiency created during the retracement wave, which prevents price from traveling deeper into our marked levels. Let us look at a more general trading example that brings together the concepts we have discussed throughout this episode. On the screen, we have the euro-dollar 15-minute chart. We can see that price moved lower and mitigated the 1-hour demand zone located beneath the liquidity pool created by the equal lows. When we zoom into that area, it becomes clear that the higher time frame demand zone was respected. After this mitigation, price pushed upward and, once it cleared the inducement level, broke and closed above the most recent major high, forming a valid change of character. From here, our next step is to search for potential long entries. The first opportunity would have been at the order block positioned at the extreme. If that entry was missed, then the question becomes where to enter next. Price has made another bullish run to the upside and has now produced a bullish break of structure, confirming that the direction has shifted to bullish. At this stage, we have two possible entry methods to evaluate. The common approach many traders take is to rely on the extreme order block. In this scenario, there is an imbalance that must be filled, and the order block sits directly beneath the fair value gap. The strategy would be to wait for price to retrace into the order block, trigger the buy limit placed at the top of that zone, and then climb higher from there. In the second option, we're considering entering the market from the fair value gap area. This approach is commonly seen in lower time frames. When entering from the fair value gap, it's important to consider a key point. You could place your entry at the highest point of the fair value gap and set your stop loss just below the fair value gap area. While this strategy can be effective at times, it's important to note that your stop loss will be very tight. Additionally, since we have an unmitigated order block at the extreme, there is a possibility that the price could push downward to fill it. So I recommend keeping your stop loss a bit wider by placing it beneath the order block. The whole point of this type of entry is to reduce the possibility of missing a trade, although it does reduce the reward to risk ratio. Now let's consider what would have happened with both of the trades. For the first option, if we had waited for that order block, this is what would have happened. Let's say that we already had our take profit set at this high. It's clear that we would not have entered this trade since the price couldn't activate our buy limit order. If we had entered from the fair value gap, our buy limit order would have been activated and our take profit would have been hit by the price. We can see that the trade played out without pulling back to the extreme order block. Before we wrap up, take a moment to consider why understanding order blocks and fair value gaps is only one part of mastering smart money trading. These tools become far more powerful when they are aligned with the underlying market structure. Without structure, traders often refine entries too much, choose the wrong zone, or expect a reaction in areas where the trend simply does not support it. That's why, before we finish, I want to show you a short clip from our Smart Money Concept series. In this segment, you will review the 4 essential market structure hacks that help you identify trend direction, understand when price is likely to respect a fair value gap or an order block, and choose the highest probability entry in any scenario. Now let's get started. The first and most essential step in reading trend direction within market structure is identifying where price is currently headed. In simple terms, you need to determine whether the market is trending or moving sideways. Price usually behaves in only 2 broad ways, either advancing in a clear upward or downward trend, or pausing in a consolidation zone where it moves sideways and gathers liquidity. These pauses are a normal part of price delivery. Think of the market as rotating through cycles of rising trends, falling trends, and range-bound periods that absorb institutional orders and liquidity. So when you open your chart, the very first question to ask is this: is the market climbing, dropping, or moving sideways? That clip reinforces a key principle that directly affects your choice between fair value gaps and order blocks. Your entries only make sense when they align with the broader market structure. When you understand the trend, the phase of delivery, and the liquidity being targeted, it becomes much clearer whether price is more likely to react to a fair value gap, return to an order block, or skip both entirely. Traders who combine structure with precise entry models are the ones who consistently select the highest probability zones and avoid unnecessary losses. So, trader, if this video helped you gain more clarity, make sure to like the video, subscribe to the channel, and turn on notifications so you do not miss the next lessons. And let me know in the comments which topics you would like us to explore in future videos. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the Lucro Trader community right here on YouTube. It's a simple way to support the channel and a smart investment in your growth as a trader. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to keep producing this kind of educational content. Please also remember that the mission of the Lucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you will find complete courses designed as a true trading masterclass. We teach liquidity, market structure, higher time frame analysis, and supply and demand, always focused on understanding price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency, because trading is not just about charts. It is about mindset, discipline, and execution over time. Our main courses include Smart Money Concepts, ICT, Technical Analysis, Trading Psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you better understand how markets really behave. Thanks for watching, and I will see you in the next video.